Look, I need to be straight with you about something that's happening right now in the precious metals market. Something that most people over 55 are completely missing. And it's not just about gold going up. It's about a fundamental shift in how wealth is being protected by the people who actually understand what's coming. 3 weeks ago, I was looking at the central bank purchase data from the World Gold Council, and something jumped out at me that I couldn't ignore. In the third quarter alone, central banks added 337 tons of gold to their reserves. That's the highest quarterly purchase in over a year. But here's what really matters. They're not slowing down, they're accelerating. And when you dig into who's buying and why, you start to see a pattern that should concern anyone sitting on retirement savings in traditional accounts.
The People's Bank of China just reported their 18th consecutive month of gold purchases. 18 months. That's not a trend. That's a strategy. They added another 23 tons in October, bringing their official reserves to over 2,264 tons. But here's where it gets interesting. Most analysts believe China's actual gold holdings are significantly higher than what they report. Why would they underreport? Because they don't want to trigger the exact market reaction that's inevitable when everyone realizes what they're preparing for. Poland's central bank governor came out last month and said something remarkable. He said they're targeting gold to represent 20% of their total reserves. They're currently sitting at around 13%. That means they're not done buying, not even close. And Poland isn't some outlier. Turkey, India, Singapore, the Czech Republic. They're all moving in the same direction, all at the same time. Now, you might be thinking, okay, central banks are buying gold. They always buy gold. But that's not quite accurate. From 2008 to 2010, central banks were net sellers of gold. They were dumping it. Then something changed in 2010, and they became net buyers. And they've been net buyers every single year since. But the pace of buying we're seeing now? This is different. This is urgent buying. This is, we need to own this before something happens, buying. Let me paint you a picture of what I think they're seeing. The U.S. national debt just crossed $36 trillion. That number is so large it's almost meaningless to most people. So let me put it in perspective. The interest payments alone on that debt are now over $1 trillion per year. That's more than we spend on defense. We're paying more just to service our debt than we spend on our entire military. And those interest payments are going up because rates are higher than they've been in decades. Here's the math that keeps me up at night. At current spending levels, the Congressional Budget Office projects we'll add another $20 trillion to the debt over the next decade. But that assumes interest rates stay manageable, and we don't have any major crises. No wars, no pandemics, no financial meltdowns. When was the last decade we went without at least one of those? So what does this have to do with you and your retirement? Everything. Because the only way out of this debt trap is inflation. Not the 3% inflation they talk about on the news. Real inflation. The kind that makes your savings worth half of what they were worth 5 years ago. And if you're over 55, you don't have time to recover from that. You don't have another 20 years to rebuild. This is it. The money you have right now needs to last you the rest of your life. I was talking to a financial advisor last week who told me about a client of his. Retired teacher, 67 years old, had about $380,000 in her 401k. All in a traditional 60-40 portfolio. Stocks and bonds. The classic retirement allocation. She came to him in 2021 worried about inflation. He told her not to worry, that the Fed had it under control, that her diversified portfolio would protect her. Fast forward to today, and after accounting for real inflation, not the CPI nonsense but actual cost of living increases, her purchasing power has dropped by about 25%. She didn't lose money on paper. Her account statement still shows a similar number. But what that money can actually buy? That's a different story. She can't afford the same lifestyle she planned for. She's cutting back on things she thought she'd be able to do in retirement. And the worst part? She's one of the lucky ones. She at least has that $380,000. Most people her age have far less. The median retirement savings for Americans aged 65 to 74 is around $200,000. And that has to last potentially 20 or 30 years. Now here's where gold comes into this equation. And I'm not talking about gold as some speculative investment where you're trying to time the market and flip it for a quick profit.
I'm talking about gold as insurance, as a hedge against the exact scenario that central banks around the world are preparing for. Let's look at what gold has actually done during periods of currency debasement and loss of confidence in fiat money. In the 1970s, when inflation was running rampant and the dollar was losing purchasing power, gold went from $35 an ounce in 1971 to $850 in 1980. That's a 24x increase. Not 24%, 24 times your money. While people holding cash and bonds were getting destroyed by inflation, people holding gold were preserving and growing their wealth. But here's what most people don't understand about that period. Gold didn't just go up in a straight line. It had massive volatility. There were pullbacks of 30%, 40%. People who were trading it, trying to time it, got shaken out. But people who understood what they owned and why they owned it, they held through the volatility and came out the other side with their purchasing power intact. Fast forward to 2008. The financial crisis hits. The Fed starts printing money like it's going out of style. Quantitative easing, zero interest rates, all the things they said they'd never do. Gold was trading around $800 an ounce in 2008. By 2011, it hit $1,900, more than doubled while the stock market was having a nervous breakdown. And here we are again. Except this time the numbers are bigger. The debt is bigger. The money printing is bigger. The geopolitical tensions are bigger. Everything is bigger. And gold is sitting at around $2,650 an ounce as I'm recording this. Some people look at that price and think they missed it, that it's too expensive now. But when you compare it to the size of the debt, the amount of money in the system, the level of geopolitical risk, gold isn't expensive. It's actually relatively cheap compared to where it's been historically when you adjust for all those factors. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where this is headed. Let me tell you about something that's happening right now in the physical gold market that most people aren't paying attention to. There's a growing disconnect between paper gold and physical gold. What do I mean by that? In the futures market, on the COMEX, you can buy and sell gold contracts all day long. Billions of dollars worth of gold trades hands every single day. But here's the thing. Most of that gold doesn't actually exist. It's paper contracts, promises to deliver gold at some point in the future. The ratio of paper gold to physical gold in the COMEX system is estimated to be somewhere around 100 to 1. For every ounce of actual physical gold in the vaults, there are 100 ounces worth of paper claims on that gold. Now, as long as everyone's happy trading paper and nobody actually wants to take delivery of physical metal, the system works fine. But what happens when people start asking for the actual gold? We're starting to see signs of stress in that system. Delivery requests have been increasing. The amount of gold in COMEX warehouses has been declining, and premiums for physical gold over the paper price have been widening. In some markets, particularly in Asia, you're paying 2%, 3%, sometimes 5% over the spot price just to get your hands on actual physical metal. That's not normal. That's a sign that physical gold is becoming harder to source. China and India, the two largest gold-consuming nations in the world, have been buying physical gold at record levels. Chinese gold imports through Hong Kong hit 54 tons in September alone. Indian gold imports are running at their highest levels in years, despite the government trying to discourage it with import duties. These aren't speculators. These are regular people who understand that gold is real money and paper currency is just a promise. Here's something that should terrify anyone who understands monetary history. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several others who have joined, are actively working on an alternative to the dollar-based financial system. They're not even hiding it anymore. They're openly discussing a BRICS currency that would be backed by a basket of commodities, with gold being a significant component. Now you might think, so what? Let them have their own currency. But here's the problem. The dollar's status as the world's reserve currency is the only thing that's allowed us to run these massive deficits for decades. Other countries need dollars to buy oil, to trade with each other, to hold as reserves. So they buy our treasury bonds. They fund our deficit spending. But what happens when they don't need dollars anymore? What happens when there's an alternative? The demand for dollars drops. The demand for treasuries drops. Interest rates have to go higher to attract buyers. The cost of servicing our debt goes even higher. The deficit gets even bigger. It's a death spiral, and the only way out is to print more money, which causes more inflation, which makes the dollar less attractive, which causes more countries to look for alternatives. You see where this is going.
Russia and China are already settling some of their trade in yuan instead of dollars. Saudi Arabia, which has priced oil in dollars exclusively for the past 50 years, is now open to accepting other currencies. These are seismic shifts in the global financial system, and they're happening right now. Not in some distant future, right now. Let me tell you what I think is going to happen over the next 5 to 10 years. And I want to be clear, this isn't financial advice. This is just my analysis based on what I'm seeing in the data and the historical patterns. I think we're going to see a significant devaluation of the dollar relative to hard assets. Not necessarily a collapse, not some Mad Max scenario, but a steady, persistent loss of purchasing power that's going to devastate anyone who's holding primarily dollar-denominated assets. I think gold is going to $5,000 an ounce at minimum, and I don't think that's a crazy prediction. If you just adjust the 1980 high of $850 for real inflation, not CPI, but actual loss of purchasing power, gold should be somewhere between $4,000 and $6,000 right now, just to match that previous peak. We're not even back to the inflation-adjusted high from 44 years ago. But more importantly, I think the ratio of gold to financial assets is going to shift dramatically. Right now, gold represents less than 1% of total global financial assets. During periods of monetary crisis, that number has historically gone to 5%, 10%, sometimes higher. If we just get back to 3% or 4%, which is still below historical crisis levels, you're looking at gold prices that are multiples of where we are today. Here's what keeps me up at night for people over 55. You don't have time to be wrong about this. If you're 35 and you make a mistake with your investments, you've got 30 years to recover. You can work longer, save more, adjust your strategy. But if you're 65 or 70 and your retirement savings get cut in half by inflation or a market crash, what's your plan? Go back to work? Live on half of what you thought you'd have? Move in with your kids? I'm not trying to scare you. I'm trying to wake you up to the reality of what's happening. The financial system that worked for the past 40 years, where you could just buy an index fund and bonds and coast into retirement, that system is breaking down. The rules are changing, and the people who are going to get hurt the worst are the people who don't adapt. Let me give you another example. I know a guy, 62 years old, retired from a corporate job with about $450,000 in his 401k, all in traditional stocks and bonds. He watched his account drop 25% in 2022 when both stocks and bonds got hammered at the same time. Something that's not supposed to happen according to modern portfolio theory. He panicked and sold near the bottom, moved everything to cash, then watched gold go from $1,800 to $2,600 while his money sat in a money market fund earning 4%, while real inflation was running at 8% or 10%. He lost twice, once when he sold at the bottom, and again by sitting in cash while hard assets were appreciating. And now he's paralyzed, doesn't know what to do, afraid to get back into stocks because he thinks they're going to crash again, afraid to buy gold because he thinks he missed it. So he's just sitting there, watching his purchasing power erode month after month. Don't be that guy. Don't let fear and indecision cost you your retirement. You need a strategy. You need to understand what you own and why you own it. And you need to have at least some portion of your wealth in assets that have historically preserved purchasing power during times of monetary chaos. Now, I'm not saying put everything in gold. That would be just as foolish as having nothing in gold. Diversification still matters. But the traditional 60-40 portfolio, that's not diversification anymore. That's just different flavors of paper assets that all go down when confidence in the system wavers. Real diversification means having some exposure to hard assets, physical gold, maybe some silver, maybe some real estate, things that have intrinsic value independent of the financial system. Here's something else to consider: the tax implications of holding gold in different ways. If you buy physical gold outside of a retirement account and you sell it, you're paying capital gains taxes, and gold is classified as a collectible, which means it's taxed at a higher rate than stocks, up to 28% federal, plus state taxes. That's a big chunk of your gains.
But if you hold gold inside a retirement account, like a gold IRA, you defer those taxes until you take distributions. And if it's a Roth IRA, you never pay taxes on the gains. That's a massive advantage, especially if gold does what I think it's going to do over the next decade. The difference between paying 28% in taxes and paying nothing could be hundreds of thousands of dollars. Let me walk you through what a gold IRA actually is, because there's a lot of confusion about this. A gold IRA is just a self-directed IRA that holds physical precious metals instead of stocks and bonds. The gold is stored in an IRS-approved depository. You don't keep it in your house. It's fully insured. And it's still your retirement account with all the same tax advantages. You can roll over funds from an existing 401k or IRA into a gold IRA without triggering any taxes or penalties. It's a direct transfer. The gold is purchased and stored on your behalf. And you can take distributions in either cash or physical gold when you reach retirement age. It's not complicated. It's not some exotic strategy. It's just a different way to hold your retirement assets. The key is working with a reputable company that's not going to gouge you on fees or push you into overpriced coins. There are a lot of bad actors in this space who prey on people's fear and lack of knowledge. You want a company that's transparent about their fees, that offers competitive pricing on the metals, and that has a track record of actually delivering what they promise. Now let's talk about timing, because I know what you're thinking. Gold is at all-time highs. Shouldn't I wait for a pullback? Here's the thing about waiting for pullbacks. Sometimes they come. Sometimes they don't. Gold hit $1,900 in 2011, and people said it was too expensive. Then it pulled back to $1,200, and people said it was going to zero. Then it went to $2,000, and people said they missed it. Now it's at $2,650, and people are still waiting for the perfect entry point.
You know what the perfect entry point is? The point where you actually take action. Because the biggest risk isn't buying at the top. The biggest risk is not having any exposure at all when the real move happens. If gold goes to $5,000 or $10,000, does it really matter if you bought it at $2,600 or $2,400? You're still going to do well. But if you're sitting in cash or bonds when that happens, you're going to get destroyed. Let me tell you about the mechanics of what I think is going to drive gold higher from here. It's not just central bank buying, although that's a big part of it. It's not just geopolitical risk, although that matters too. It's the fundamental supply and demand dynamics of the gold market. Gold mine production has been essentially flat for the past 5 years. We're not finding new major gold deposits. The easy gold has been mined. The ore grades are declining. It's getting more expensive to extract gold from the ground, and at the same time, demand is increasing. Not just from central banks, but from retail investors, from institutions, from countries that are trying to diversify away from the dollar. The World Gold Council estimates that total gold demand in 2024 is going to exceed 4,500 tons. Mine supply is only around 3,000 tons. The difference has to come from recycling and existing stocks. But there's a limit to how much recycled gold is available. And existing stocks are increasingly being held by strong hands who aren't interested in selling. This is classic supply and demand. When demand exceeds supply and supply can't increase quickly, price has to go up. It's not complicated. It's basic economics. And we're seeing it play out in real time in the gold market. Here's another factor that most people aren't considering: the energy cost of mining gold. It takes a tremendous amount of energy to extract gold from the ground. Diesel fuel for the trucks and equipment, electricity for processing. As energy costs go up, the cost of producing gold goes up. And that puts a floor under the gold price. Miners aren't going to sell gold for less than it costs them to produce it. Right now, the all-in sustaining cost for most gold miners is somewhere between $1,200 and $1,500 per ounce. That means gold is very unlikely to go below that level for any sustained period, because miners would just shut down production. But here's the thing: those costs are going up. Energy is getting more expensive. Labor is getting more expensive. Environmental regulations are getting stricter. The floor is rising. So you've got rising production costs on the supply side and increasing demand on the demand side. That's a recipe for higher prices. And when you layer on top of that the monetary factors, the debt crisis, the geopolitical tensions, the loss of confidence in fiat currencies, you've got a perfect storm for gold. Let me address one more concern that I hear all the time. Gold doesn't pay dividends. It doesn't generate cash flow.
It just sits there. That's true. Gold is not an income-producing asset. But here's what gold does do. It maintains its purchasing power over long periods of time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about the dollar?
In 1920, you could buy a nice men's suit for $20. Today, that same suit costs $2,000. But an ounce of gold in 1920 was worth $20. An ounce of gold today is worth $2,650. Gold maintained its purchasing power. The dollar lost 99% of its value. That's what gold does. It's not about getting rich. It's about not getting poor. And in retirement, when you're living off your savings, not getting poor is the most important thing. You need your money to last. You need it to maintain its purchasing power. You can't afford to see your nest egg cut in half by inflation or a market crash. That's where gold comes in. It's the insurance policy on your retirement. Think about it this way. You pay for homeowners insurance every year, and you hope you never have to use it, but you still pay for it because the risk of losing your home is too great. Gold is the same thing. It's insurance against monetary chaos, against currency debasement, against the loss of confidence in the financial system. You hope you never need it, but if you do need it and you don't have it, it's too late. I want to leave you with this thought. The decisions you make right now, in 2025, are going to determine what your retirement looks like for the next 20 or 30 years. You can't go back and fix this later. You can't undo the damage from inflation or a market crash after it happens. You have to prepare now, while you still have time. The central banks know this. That's why they're buying gold at record levels.
The wealthy know this. That's why family offices and high-net-worth individuals are allocating more to precious metals than they have in decades. The question is, do you know this? And more importantly, are you going to do something about it? Don't let fear or indecision cost you your retirement. Don't be the person who looks back in 5 years and says, I knew I should have done something. Take action. Educate yourself. Talk to a professional about whether a gold IRA makes sense for your situation. But do something. Because doing nothing is a decision too. And right now, it's the worst decision you can make.